All right, thanks everybody coming out. I did one of these in Shenzhen, which was fantastic. My Chinese wasn't very good, but people did seem to follow along. Ni hao. So I must say, thanks for the introduction. I had 2 IPOs in the 90s, believe it or not. I love the 90s. I missed the bubble. But I had one company. I pitched it in the public offering in 1999, and it had 1 million of trailing revenue, and it got to a $9 billion market cap. And so for a short week, we were the most overvalued company in the history of the NASDAQ. We were number 1. So if you ever go through that, I hope you do, ICO or IPO, I can tell you how we felt. It was like, yeah, baby. It was like we were happy. We were very happy people. All right, can I do one more thing before we get started?
Yes.
Our fund has done something like 90 deals since 2007. Who's counting? A very high percent use SVB. So I will plug SVB. They're a very good, comfortable bank to go deal with. So all of you should at least talk to them. But they are a bank in the end, so you have to deal with that. But they're a really good bank. They've been around forever, and they love working with startups. I think about half our companies use them at the moment.
So what is Bullpen? How did you start it? Maybe you can walk us through all the history till now.
So what's very interesting to me is that I was in a big venture fund before Bullpen, and I don't know if people here realize there's been a complete disruption of venture capital about 15 years ago. So in the 90s, when I had these startups, our first check, and one of them was $10 million from the VC. Well, that's still on, I think, right? And the next one, it was 20 million. And so you start a company, you really need a $5 million check or bigger to get the whole company going. I was on the board for many years of an enterprise software company, and we figured it took $35 million to know whether you had a real company. Because you had to go buy servers and pay for Oracle software and hire bag-carrying salespeople, and you didn't really know for a long time. And so what happened in the 2000s, I lived through. I was in a big venture fund, had a $1 billion fund. When I first started, it had $2.2 billion to invest. It's crazy. And we did MySpace, and so some of you might remember MySpace. Facebook might follow the same trajectory shortly, but MySpace was big. And because we did it and got known for it, every startup in the social area came roaring into our office in 2005 and 6. Damn, except that one called Facebook. Every other one. But we normally wrote a check. You're at a big fund. You've got to write a check that's big. If you think about it, you have $1 billion. How many deals are you going to do in a $1 billion fund? You're going to do 20, 25? Do the math. So you try to write a $15 million check. These companies came in, how much do you need? 500,000. So we can't do 2,000 deals in a portfolio. So I realized this is about 2006, something fundamental was changing in the venture world. I now call it the era of cheap. This whole world where you go to an accelerator, and then you go to a seed fund, and then eventually you get a Series A, did not exist 20 years ago. 20 years ago, you had to get a Series A. You had to go to Kleiner Perkins or Sequoia. You had to bow to them, and you had to get the money. It's completely changed. It's democratized startups in a way that was unfathomable back in my day. For a lot of people here, when I was raising money, I had to have pedigree in my group. Oh, we came out of Apple or HP. And it's all Stanford white guys, right? We all know the drill. Today, it's much more democratized because in today's world, you're not just starting with cheap money. You're launching so fast, mobile or the internet. It doesn't really matter who you are because you're proving it or disproving it. So Bullpen was formed with an insight that in this world of era of cheap, we don't have to look at a company, did you go to the right schools? Did you have the right pedigree? We don't have to do that. Oh, we look at your numbers. Okay, you've launched. Are you growing fast? You're growing like crazy? Is your technology built in a modern way? A lot of the things that back in 1998 you had to guess about, we now know. And so I just want to convey to you how different this is than it used to be. You're living in a glorious moment of history. So if I can ramble a little more, what's about to hit big time, already started, there's some people in the room who've done them, are the ICOs. So we saw a big disruption in 2005, 2008, era cheap. Now we're seeing a second huge disruption of the venture industry going on right now with ICOs. So you're living through, as the Chinese would say, interesting times.
I'm just curious, who raised ICOs or maybe bought altcoins or Bitcoin from the audience?
There you
I
go.
also bought some, but that's interesting. Cool. who's considering, just curious, who's considering doing an ICO, like in the next 6 months? Maybe somebody, okay. What is going on? I mean, it was a hot topic perhaps a couple of months ago, but now sort of cooled down, or what is happening in this space? Just from your insight, yeah.
First, from a very high level, the venture industry got really good at funding companies and eventually trying to take them public. What ICOs are doing are funding more ecosystems. We were actually moving up to funding a more complicated organizational structure. Now, the negative is the SEC has no idea what to do about it. So some of you may know they just did a really big sort of give everybody a subpoena thing a couple of weeks ago, which put a bit of a chill in the ICO market. But the ICOs are the next step in funding things that are more complicated and bigger. A lot of the ICOs are not really companies, they're organizations. Some people embrace the idea of a distributed autonomous organization. You're funding an organization. Now, in my portfolio, we have one company that's done an ICO. It's kind of interesting, I'll tell you more in a minute. We have another one that started itself as a utility for a whole supply chain. And what they're envisioning is, right now, if you do SaaS software, every company's got to sign in. They have their own SaaS version. Even Slack is like that, right? You got your company Slack and you sign in. So they're thinking, that's so stupid. It's so last decade. Let's have everybody sign into this whole supply chain once, like Slack, but now you're a member of the whole supply chain utility, not your individual company. And you begin to transact through the whole supply chain. And they use the blockchain to make sure every contract is immutable going forward. So this is a different way to think about funding something. It has a company in it, but it's not really a company. It's much more of a utility over a whole supply chain. And I think over the next 15 years, there's going to be a revolution across all of finance. We're just in the early days right now.
Cool. So just on that note, do you hear me okay, or? Okay, cool. So on that note, I mean, definitely there'll be a Google or Amazon in this space. How do you, like, there's a lot of noise and a lot of companies will be dead by maybe next month, or I don't know, a couple, who knows? Nobody knows, I guess. But how do you sort of sort the things out? I mean, how do you understand what is the signal, what is the noise?
So I'll give you a story. Y Combinator, their premier accelerator, has done maybe 1,500 deals. Their real success rate is probably 4% of them. So a lot of deals, but it's a handful that are really becoming a Dropbox. It's a huge success for them. And maybe 10% will become really interesting companies. So the reason I say that story is they're their premier accelerator right now for startups. In the ICO world, look at the stats. Oh my God, 90% of ICOs fail. Sounds horrible, right? But it's about the same success failure rate of the whole venture industry. So first of all, people overreact to something that's new. So people overreact to ICOs. What I think is going to happen going forward is the SEC is sort of rumbling and stumbling into creating a safe harbor. So right now, if you launch an ICO by using a SAFT, now you people know what I'm talking about because I'm sort of going, you all know SAFT? Okay. And you do an accredited investor deal and it's under Reg D, a safe harbor from the SEC rules. Fine, that's great. And then you put it on an exchange, a token exchange. You have just done an illegal public offering. And by doing a SAFT, you sort of told the SEC, we think of our token as a security. So you're forever in the security mode. And this freaks people out because when you think about the idea of a tokenized economy, it's like a utility thing. It's like a parking. Think of a parking. This is my favorite example. You have a parking token. So let's say you're a self-driving car and you want to park. Okay? How do you do it? Drive up to a downtown garage, big burly guy looks at you and there's no driver? No. You will go out on the internet and you will auction off, I need this parking spot for 2.5 hours in this area of San Francisco, and you will buy a parking spot with a token, parking coin. And then you zip in and park and you leave exactly 2.5 hours later. Now, if you think about that parking coin, if that parking coin is a security in a public offering, every time the parking company issues more, they got to go to the SEC and follow rules. You suddenly totally screwed up the whole vision of these things as creating this huge economy like a parking coin. So what's going on now is the lawyers told people, do an ICO, do a little SAFT first, you're going to be fine. And the SEC said, no, you're not going to be fine. So when I say the SEC early days, they're trying to figure this out. What I think will happen is they will carve out another Reg something, Reg E, which will become a safe harbor for utility tokens. And once they define this, if you follow the rules, you can launch your utility token without it being a security, and you avoid all this SEC scrutiny. And I hope that happens in about a year or less, because right now the market's somewhat confused. Okay? Again, if I'm diving in too level, is this okay? Okay. Tell me if this is too deep or too shallow.
Okay, so there was a question before somebody asked me in the networking part in the beginning was, like, what is the future of all of this? Like, where do you see this, like, applications of, like, parking, perhaps, or like micropayments, or what are the sort of?
Okay, I'll do a leap. I know what you're asking. So, if you go back 25 years, the internet. All right, I was there in the early days. You gray hair. So it means I was able to have the fun of the internet. And in the early days of the internet, it was completely wacky. You go to a session like this, and there were hundreds of terrifically crazy ideas, and it was all new and fresh, and everything was possible. And probably the government did one of the best things it ever could have done. I give Al Gore a lot of credit for this. If anybody remembers Al Gore. He didn't invent the internet, but he made the government regulate it in a lightweight way. So instead of having onerous SEC rules on the internet, no, hands off. So for 25 years, the internet grew spectacularly well. And we created what I'll call the Internet of People. I think one way to think about the token economy is it's going to create the internet for machines, like the self-driving car talking to a parking garage. That what the tokens represent, and with inside of it, so-called smart contracts. You've heard smart contract, I hope. By the way, they're really dumb. Like a smart contract might be turn light off at 8 o'clock. That's not very smart, but it's automatic. So I think of smart contracts or the distributed applications as automated operations. The rules hit, bam. That's how machines think. Machines don't negotiate. Machines have rules. So you're going to create this whole economy of machines out there, little robots and cars and things that chatter with each other in distributed apps. And so you can imagine in 15 years when you're bopping around San Francisco, it's going to be glorious. The machines will all be in the background chattering and bubbling and doing transactions. We can just ignore them. We get in the car and we go somewhere. It's going to be great. So I think we're building the Internet of Things, the Internet of Machines, not the Internet of People. And that's, I think, the thing that people don't understand about this revolution. They're still framing it as, how does a person use a token? No. Why should we use a token? We have dollars. The machines, though, perfect for them.
So if you're investing in like the ecosystem more than an organization, are you really just like seeding it or bootstrapping it with money, or are you acting as a bank?
No, that's a very interesting question, because the venture industry does not know, and so you think we're all smart. Nah. So for example, when this revolution of the era cheap started, they invented a new financial instrument, the CAC Convert. Now you're probably all familiar with it. Now it's a safe. But 10 years ago, nobody had a clue what this thing was. And it took almost 5 years of using them before people figured out economically what they were. So it just takes human beings much longer than a machine to figure out the rules. So I think what's going on right now is as revolutionary as the internet, but the rules are very unclear and the opportunities are unclear. So you can see multiple token offerings for duplicative companies. So how many Ethereums are out there? There's dozens of them now. So we have Filecoin and other file storage systems. And everybody goes, this is crazy, but it's not. Back in the days of the .com, how many pets.com did you have? My God, you had 5, 6, 7. There's very duplicative deals, so I'm not worried about that. What I am thinking about as a venture person is the following. Will the ICOs bypass venture altogether and create another way to fund, or are we going to participate in this? Okay, that to me is a more important question. So here's an example. We have a company called GameFlip. So for you gamers here, GameFlip lets you trade stuff. A magic power in this game for a sword in that game. Right? It's kind of cool. And they have a pretty robust marketplace doing this. Well, they said, my God, why are we doing barter? That's so like barbaric. Let's do a token. We can have a coin. So they launched the Flip coin in a nice ICO. So they did their ICO. They sold 14 million. They only cleared around 7 just because of overhead and marketing costs and lawyers. And so anyway, but here's the amazing part of this. So I'm going to tell you how I worry, what I worry about, but here's what I love about it. Have you all heard of a perpetual motion machine? You heard about this? Okay, this is a thing in science that creates some kind of machine that never runs out of power. It's like cold fusion. So perpetual motion machine. And we know under the conservation of energy it's impossible, but every couple of years somebody says, I found one. And okay, no you didn't. I think what the tokens look like, utility tokens, is a perpetual money machine. Here's why. They do their token offering, it's on an exchange, it's liquid. They only raise 7, they want more, they just issue more coin and put it on the exchange. So they're up to 15 now. So after they did their initial offering, they can keep dribbling money out there, coin out there. Do you get this concept? Because this concept is so good. You've got to get this concept, a perpetual money machine. If you launch your token, it's on an exchange and it's still got value. You can keep on adding more to it. Now, isn't that cool? Come on. Okay.
Yeah, I mean, it suffers from inflation and like yeah. But so I'm just wondering with your car example.
Whoa. There may be inflation. You can't put too many out. What does our federal government do? Prints money all the time. So you got to be careful. But it's a cool idea. And the problem, what you have to get your mind around is when you do a utility token, you're doing this, that money you're coming in is actually not just free money. It's your revenue. You're now getting paid as a company in tokens. So you issue tokens, people buy them. It's like you're selling somebody a prepaid gift card. So it's prepaid revenue. So that's your revenue that's coming back. And as long as you're growing, you have a perpetual revenue machine. Get your mind around this. I know people have a hard time. But from a venture point of view, here's my issue. I put money in the company. I put Series A, Series B. Suddenly they do a token offering. Do they need me? No, they get a perpetual money machine. So I have to think about what happens. They don't have to come back to the capital markets. They never go public, they never sell the company. What am I, chopped liver? So the VC industry has not figured that out. So they're figuring that out as we go.
And continue on with the conversation that you mentioned before, how do you imagine a VC will contribute to that space? Because I feel like you have a lot of value to offer.
So if you heard the question, we know about pre-seed, seed, post-seed, A, B, C, and the letters go on forever and eventually go public, right? What's the equivalent in the ICO market, and why do we even care about venture people? Well, first of all, maybe you don't, right? We're annoying. Maybe you don't care about us. But I think what's going to happen is this. I think when the SEC creates this safe harbor, you'll need funding to get to it. So right now, a lot of people launch a white paper. It'll be ready in 5 years, and it's all wonderful, and they raised $100 million. That's probably going to get them in trouble. Instead, you use venture money to get the company to the point, like a game flip, where they can launch the utility. And then the launch of the utility is not a security. It's prepaid revenue. So I think we do have a role. If not, I'll retire or move to Australia. That's a save, yeah.
So can you pass it?
You have the mic? Yeah. Australia sounds nice. So to play devil's advocate.
Wait. Look at his shirt. Everybody look at his shirt. Why is there no Dogecoin on that? I want to see Dogecoin.
Only serious tokens here, obviously, if there's such a thing. But to play devil's advocate, Vinny Lingam of Civic kind of posed an alternate view that a token that raises both equity and ICO funding is actually trying to serve two masters. The equity side is trying to go closer from selling to startups to selling to small businesses to selling to enterprise and IPOing. The cryptocurrency side is trying to increase the value of the coin. So PR releases, partnerships, good press, maybe improvements on product, what have you. But less so on the sales side, right? More so, you could say image and branding side. So how do you kind of either merge the serving of two masters or put one ahead of the other when it comes to that?
Well, first of all, Vinny is one of the greats. And a Civic is a really cool idea. And he was early into the whole coin thing. So I love Vinny. And he's right. And I think the problem is that the legal community and the ICO community, this only really started bubbling a year ago. It got so excited, it took this pathway of a pre-ICO in a SAFT all the way to drop on the exchange. And they didn't realize they're going to walk into the SEC buzzsaw. So now today, we know there's an SEC buzzsaw. So people have been trying to say, let's have a security token and a utility token. Maybe. But the SEC will not believe you. So you shouldn't serve two masters. I think of the utility token, as I said, as prepaid revenue. It's really the revenue from the operation of whatever the utility is. And that the security token, if you do that, or regular security money, is meant to finance the company. So I don't think you are serving two masters. It's just right now the two are conflated and confused. And people might go to jail. Who knows? Did that answer your question, by the way?
Yeah, I mean, I've got tons more, so we can get back.
You got one for every company on your T-shirt. I love that.
Thanks for the Bitcoin chaos here. I have a question for you. This is buzzing. How do you feel about seed investors who invest in a Series seed and then the company pivots into blockchain technologies and doesn't do a Series A?
So first of all, I'm amused because there's been no question about venture capital really yet. It's all about ICOs. So what's in the water here? It's okay. We have companies, I have 3 companies in the middle of coin stuff. One of them started as a crypto company, got venture funded. We always knew it'd do it. The other 2 did their pivots. Exactly what you said. How do I feel? I think myself as an investor have to have some kind of right. So right now, if you have convertible preferred stock, at some point it converts to common and you sell it when the company goes public. We may need to create a warrant or some right that if you do an ICO, we can convert to the token and then dump it on the exchange and get liquid. It's a little early for this because for a venture fund, it's more complicated than you might imagine. We answer to our own masters, limited partners. They have restrictions in our agreement of what we can invest in. Cannabis is hard, for example. Gambling, oh my God. So there's restrictions, and crypto has to be created as something you could invest in. So we have to go through our process to figure this out. That's that time frame I said before you really figure it out. But I think that's what's going to happen. That if a company is so successful on the crypto side, they don't need to keep on going to capital markets, fine. We'll just flip over to the crypto world and get liquidity that way. Did that answer your question?
Sort of, kind of. I was more thinking of, you have all of these angel investors in the Valley who dumped money into like seed companies, and now a lot of them, are going into crypto, and they're, someone signed a safe, and now they're sort of, on ice because the company's not going to do a Series A. There's no liquidity down the road.
Yeah, I guess be careful out there. Okay. No, seriously. I mean, people often rush and they don't think, and they can get in trouble. So there may be a lot of money lost in this. The good news is for an investor, the SEC may go after the exchange. They may have to go after the lawyers. They may go after the company. They may require it to be registered. But you as an investor, they don't go after you.
Yeah.
The token may go to 0, but they don't go after you. So, all right. Anybody got a real venture question here? What's this token stuff?
So what do you look in the founder prior to making an investment? So more like...
Well, it's what I said earlier. It's a good question. First of all, not all VCs are the same, but most VCs have a certain requirements in the founder and all that. I'll give you a story. One of my favorite founders is Tracy from a company called Tradesy. It's a rent the runway thing. I get those names, they're too close. And she came in and pitched us. And she was so awesome. I mean, she knew everything about her business. We asked her questions, she nailed it. Asked another, she nailed it. We were like in awe of this woman. That's what we look for. Somebody who knows their business so well. They know it upside down, inside out, sideways, and are feisty and aggressive, and they know what they're doing. So that's what we love. So
you invested in the company WAG, which like on-demand dog walking. So what was that pitch in that room when you decided to
well, this is interesting. You guys all know WAG? You know WAG? Yes. That's cool. Who's got a dog? Who's used WAG?
Well, pretty the same people that raised up the hand when you asked.
I love that. So I really do. So here's the thing. 2 things about WAG struck me. So first of all, We knew the founders from a prior failed company. So, but we knew they were incredible growth hackers. If you meet them, the Vinner boys, you'll know immediately what I'm talking about. They just knew how to grow something. They knew every trick, they knew how to tweak. So when they launched WAG as a product, there were other dog walking things out there, but this one looked just like Uber, little dog bones instead of cars. And it was so well thought through, and they were hacking and everything. They're still doing it. So that's why we loved them at one level. What I learned later was fascinating to me. So it turns out 70% of the walkers are female. 70% of the users are female, which I saw in this answer here. And it's interesting why. It's like, okay, why would that be? And the answer has to do with human nature. So you're working late. Maybe you work at Sony. It's 5 o'clock, and you've got to press in to get something done. Your dog needs to get walked. You're not going to call your husband or boyfriend. He's worthless for this. You get on the phone, you talk to a bunch of friends who would walk the dog. So it actually hurt women trying to press in at work because they had to be the caregiver of last resort with the dog. All right? So if you guys agree with this? I see some nods out there. Well, we didn't know this going in, but we found this by surveying the user group. We said, this is amazing, actually. So that was the second thing. And it got me to look at other deals like this where they're, see, the women in the audience will get this immediately. Male venture capitalists take a while to figure this out. The women would get it very quickly. So I began consciously looking for other deal ideas where this phenomenon would be in there because I knew the boy club in venture would not get it. So that was the second thing I loved about it. Okay?
Yes.
Sorry, still a token question. I was wondering, because you talked about the Internet of Things, do you think there could be also another Internet of People through those tokens? For instance, Orchid Labs talks about that with making an internet free of surveillance where you could take care of your own data, that nobody could take them away from you. Do you think there could be also in this space a new Internet for people?
Well, I probably would have thought it had been hard about 2 weeks ago. I was weirdly rushed onto a TV thing today to talk about Facebook. And so, Facebook, they gave away the social graph. They're, how stupid. So Zuck's out there talking about security. We're a secure company. Well, nobody said you got hacked. You gave it away. It's privacy we worry about. So immediately the mind begins to say, okay, Vinny Langham's kind of doing this. Why don't we create a blockchain-based identity for you? And why don't we say that Facebook has to use it and obfuscate all your personal data inside of Facebook and has to obfuscate it if it tries to sell that to advertising. We do that anyway in mobile using Ad ID, if you guys know about Ad ID. So you could imagine that there'd be an internet for people using blockchain, which would be more secure. And then the graph, the trust graph among people would actually be much better. It'd be hard to get a spammer to spam you with a fake email because the trust graph underneath could figure that out. So yes, there will probably be great improvements in internet for people too. Okay? Who's turned off Facebook? Anybody? All right, cool. Maybe. Okay. But not Instagram, I bet. There was a question over here first. Did you?
We can go, yeah.
Linda, do you have a question?
Oh, wow. I was just curious about how you prioritize your investments. When you obviously were looking for something more unique, which were influenced by WAG. I'm just wondering, do you look at, just curious as you're, I guess, prospecting, and do you look at psychological behaviors of men versus women to see where the voids are, the niches, the opportunities?
We don't do it in that way, but it's a good question. So what Bullpen, so first of all, let's talk about investing in general. If you talk to the great investors, I'll tell you something. So I can't draw it, but imagine a 2x2 matrix. I used to be a consultant. Everything's a 2x2. Okay. So one axis is, are you right? And the other is, are you wrong? And the vertical is, are you with the herd or are you contrarian? And it turns out in all of investing, I mean, obviously you're wrong, you lose money. But it turns out all the great money's made when you are right and contrarian. Now it's very important. The Big Short, you guys saw that, a huge contrarian bet. They were right. It's kind of cool. So most investment people get that, and most venture people say, well, I'm a contrarian. But they vote, they bet with everybody else. So how contrarian are you? If everybody's contrarian, nobody is. The venture industry is a funny industry. You find out that near the top, if they anoint a deal as a hot deal, everybody's got to get into the deal. So Bullpen says, I don't want to be in that deal because it's going to get bid up and the arbitrage you might get for being right is going to get eaten out by all the other assholes. Forget it. So we have a thesis that the deal has to be one-off, not two-off, but one-off. For example, we have a parking deal. This whole parking thing I talked about is one of our deals, Spot Hero. You guys all should use Spot Hero. It's the WAG of parking in San Francisco. It's really cool. It sells the marginal parking spot cheaper, like the marginal hotel room, marginal airplane seat, so it's cheaper. So, guy that started it, Chicago. Wrong city, one off. And at the time, you guys remember Xerx and Lux? You know, little valets in the blue shirt or the green shirt, and they come out in their little scooter and they move your car somewhere. Remember this? That was what everybody thought. The venture people thought, that is the right bet. Both of them are gone. And our little blue-collar Spot Hero is crushing it. So one-off, different city. It also means different founder. So we tend to like founders that aren't two dudes in comp sci from Stanford or Harvard. Right? Everybody invests in those guys. Who here is from Stanford? Anybody? Ah, you see? There you go. We got the right crowd here. So one-off, not what the herd thinks is what it should be. We want to look at people a little different, right? And also categories. We get lucky sometimes. A few years ago, e-commerce was a dead category. No money's made in e-commerce. Even when they get bought by Amazon, it's like 1.5 times sales. How awful is that? So we found this incredibly clever e-commerce deal. And I can describe it. It's selling Whole Foods ethic to aging hippies in Oregon. It's some way of doing it. So there's no Whole Food store near there, but they're selling toilet paper, recycled. They're selling good perfume and stuff, good shampoo. And they had found this incredible low-cost way to get to these people all over the country. So they were crushing it. But since e-commerce was out, they couldn't raise a dime. Now, it turned out, right after we did the investment, Jet.com gets bought for $3 billion. Chewy, a dog food thing, I don't know, $4 billion? I can't remember. And Dollar Shave Club, close to $1 billion. So all of a sudden, e-commerce is hot. We look smart. Just contrarian. A category out of favor is great to invest in because you get in at a very good price. Okay?
Got a question back here.
Thanks. So I understand Bullpen focuses on post-seed, pre-A. Are you seeing any blockchain-oriented companies that fall into that category based on their business metrics as opposed to, say, a successful ICO on a white paper?
No.
So still early? Too early?
Most of the blockchain companies are either like tokens for token's sake. Another Ethereum to let you be a platform for smart contracts sold to the Ethereum developer community. Nothing wrong with that, but it's okay, fine. We tend to like things that look a little unique. Or they're a white paper, and they're a little early. So they'll come to us. I'm not worried about that. But no, it's a little early for that. It's not that I already have, though, one token out, one really good crypto company that's soon going to launch, and 2 others that are going to launch as well. So it's what we heard over here. Sometimes what happens is they go through their process and they pivot into the token side. And if it makes sense, we roll with it. So I'll probably have 4 token deals by the end of the year. Maybe a 5th. Who knows? Who's counting?
So I've read just as much money is getting invested overall from VCs, but it's coming from it's going into fewer companies. Is that a trend you're seeing, and if so, why? Do you think it will continue?
First of all, that's a venture question. I love you. This is good. Not a token question. So what people don't appreciate in the history of venture is it's cyclical. So from 1978 to 1983, you people were not even close to being born. There was the PC bubble. Steve Jobs goes public in 1980. He's worth $1 billion in today's money, and he's younger than Zuckerberg. And it was a crazy time. One of my favorite companies was called Kentucky Fried Computers. It went public. It changed its name to Northstar. There was NBI, nothing but initials, NNC, no name computer. It was a wacky time. And then it ended. And the venture industry got so depressed that by 1990, 1991, we created something called Joint Venture Silicon Valley because we thought Silicon Valley was over. And then, of course, the internet hit. And you had everything, pets.com. But again, the internet started around 94, peaked in 2000, and then nothing for a long time. And so we're now in the third wave, at least of this cycle. First, driven by a microprocessor. Second, by improvements in networking. The third, mostly by an iPhone that I have here. And so the third wave, this wave, I hate to tell you, peaked already. It peaked in third quarter of 2015. If you look at the stats, it's vividly clear. It's going boom, 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 boom. Now, it's not visible like 2000 because there wasn't a huge dot-com bubble bursting in the public markets. Because the US government, in its wisdom, killed the small IPO. It was all done in the private world, not the public. But it really did affect the whole ecosystem. As far as I can tell, startup funding, seed if you like, pre-seed, there's so many versions, angel, is down 45% since that peak. The number of startups is down not quite as much, but it's down quite a bit. So you're in the down cycle already. And you're right, what's happened is venture has stayed fairly constant, if not increasing, but you find it's gobs of money into a smaller and smaller group of companies. Like my WAG just got $300 million. They were trying to raise 75 million and SoftBank shows up, right? Here's 300 million, okay, take it. And so that shows up in the stats as a gob of money. It's just one deal. It could have been like 20 B rounds, but no, it's one deal. So yes, you're right. So, but don't worry. We're on a downturn from the social mobile thing that Steve Jobs probably did with the iPhone. And the frontier tech is now coming up, including blockchain. And I think over the next 15 years, we're going to look back and we're not going to realize how different the world is in 15 years. And it's going to be mostly, I think, because of the blockchain and invading everything. Okay, so I'm back to tokens again. By the way, can I just do an editorial here? I was thinking of writing a book once, and I was going to start it with this way. If you're an American, sorry for people not from America, you're an American in 1895. You live on a farm. You have no electricity, no telephone, no TV, no internet. Your basic mode of transportation is a horse. You're within 5 miles of a city, so you can take all your produce there and back in one day. You wait desperately for the train to come in, so what you bought from Sears catalog will be dumped in the city. You can take your horse and cart. That's your life. Your life is manure. Smell that fresh country air. 15 years later, 1910, there's airplanes flying overhead. There's cars on the street. The horses are gone. New York actually smells okay. There's telephones. There's electric lights. But best of all, washing machines. Imagine without washing machines. Modern dentistry. Things got so much better in 15 years. If you had gone from farm to city, you would have felt like you'd walked into the future. You're suddenly in a Jules Verne novel you couldn't imagine when you're growing up on the farm. So the reason I say that, I think in 15 years, and I want everybody here who can find me if I'm still alive in 15 years, I challenge you. I bet in 15 years, if you figured, what was it like in 2018? You're going to be gobsmacked, good Australian phrase, gobsmacked at how the world's changed. You're going to walk into the future. It's going to be an amazing future. All these little machines in the background doing stuff for us. Okay? Cool. Can I answer your question? Probably more than you wanted.
So another question about categories. How are you looking at investing in IoT in general? Are you looking at it in as an ecosystem question, or are you looking at it as a solution to a problem? How are you looking at it? And are you investing at all?
We have looked into all these frontier tech, and IoT is one we thought had a lot of promise. But consumer IoT is not going to go anywhere until somebody like Google or Apple or maybe Amazon anoint it. And we already see that happening. Industrial IoT is so slow. I mean, it's like the selling into the industry, it takes forever. So we've chilled out on IoT. And I have 2 IoT deals. Both, by the way, are going to pivot into token offerings because the industry is too slow. These people just take too much time. And so I've cooled off on IoT. I think it's going to be big, but not big in the way that venture people would want. It's going to be big in a different way. Big corporations will grab it downstream. Okay? Are you in an IoT deal? Pivot, token deal. Okay.
So my question is in regard to seed after Series A, so you're like in between. What are the signs that you're looking at, and is it financial, or is it deal flow, or is it contract coming in? What is the trigger or is it a bridge round that you are interested in? What is that middle point?
Well, it's a great question. But first of all, I'll tell you the following thing. We never, ever do a bridge. Most bridges are piers. They go halfway to the lake, you sink. We don't do bridges. So we saw post-seed this way. And it's funny to look back on. So in 2010, when we first started conceiving of this, being who we are, we did a lot of analysis. We looked at other portfolios and looked at the deals and tried to figure out what was the character of a thunder lizard, as Mike Maples would put it. And we found out that a very high percent of deals jinked and jived before they found their inflection point. You probably don't know this, but Twitter couldn't get funded in Silicon Valley. Spark from Boston had to fund them after they'd been rejected. So, but they rewrite history. History always is like it's up and to the right, always easy, never as easy. With that insight, our second insight was, at the time there were 20 seed funds. We said there might be 100. Do you realize there are over 500 micro VC funds now? I don't know if you know that. So the numbers are fascinating to us because in 2000, when I was doing my IPOs, there were 1,000 venture funds, seed A, B, C. And by 2010, 2011, fewer than 100 were still active. Huge ramp down and consolidation of venture. And of those 100, I think the number was actually 85 at the time, they all got really big. It's like me and Vantage Point, and I saw MySpace, these deals come in at 500,000, and I had to write a $15 million check. And you can't get promoted in a big venture fund writing $500,000 checks. I go, really? Get out of here. So I realized, number two, that seed would explode and the Series A would get turgid and constipated and they would go for big checks and wait. So our insight wasn't that we're in between, but that there needed to be a new round. And it's really a small A round. There always used to be a small A, but these funds behind us, they want to write $10 million checks. They don't want to write $2, $3 million checks. So the small A went away. Now I can prove how clever this is with a simple stat. Right now, the seed to A graduation rate across the whole industry is under 10%. Now people tend to think the good ones will get it, but that's still in the low 20% range. The post-seed, bullpen post-seed to an A is 70%. And what's even more fun for me is that the average round after us is 15 million on 45 pre. If you guys don't understand the lingo, 15 on 45. And so you realize immediately, it's not an A round, it's like a B round. But these funds all tell their limited partners, we do A rounds. So we do everything we can never to call a round an A round. So they can put in 15 million and say, we do A rounds. Does that sound really dumb? It does, doesn't it? Gamify the whole system, but it works. And so we figured out that the efficiency of this market requires that round, not as a bridge. We will only do on a scaling company that exceeded their seed milestones. And we tell them, do this post-seed round, 3 or 4 million, set up the big round, and it works like a charm. Does that help?
We've got a question back here, but quickly, I was wondering, if you could go back 5 or so years, what's a company that you wish you'd invested in?
Besides Uber?
Besides Uber.
But you know, there are a couple I wish I got into that we couldn't get into at the time. One of them didn't quite work out. It was TaskRabbit. Cool company. Leah was great. She was our type of CEO. I don't know if you know TaskRabbit. It didn't quite work out, but I still would have loved to have her as one of our CEOs. Another was Thumbtack, which is service thing, did really well. So there's a few like that we missed, mostly because at the time we didn't have enough capital to really play. So it's sad. But Uber, I got to tell you a story about Uber. So Uber starts off as, you read their initial business plan, black limos, use the smartphone. They even thought they would build a fleet of black limos. It was nothing like the Uber of today. Nobody should have invested in that company. It gets back to my point that a lot of these companies do a clever pivot and then inflection point hits. They don't do it from the start. And that's a big lesson to all of you. Pivots are okay. We like you to pivot before you come to us. But pivots are okay. These are all experiments into the marketplace, and you got to track where you're going to get your best bang for the buck. You don't have to prove you were right. You have to be right. It's a different thing. Lindsay, is that good? Okay.
Yeah, thank you. Yes, please.
So yeah, thank you
It's
so
like
much.
authority in having the mic, you know?
So you mentioned the contrarian kind of perspective towards, heading with things. That's kind of counterintuitive when it comes to IoT. So when you see IoT, you always hear 5 words: VR, AR, wearables. And I think the problem with IoT is they treat it more like a saturated market. Everybody wants to do fitness and less of data capture solutions. My theory on IoT is that the more variety in the data you capture, the more successful you can become. More than just everybody trying to capture the same thing over and over again. What's your thoughts on that?
I have a different perspective. I think IoT is just immature at the moment, but with the blockchain, it can get very mature. Here's why. You look back in the history of computing. So Bill Gates got an A+ for the PC, a computer on every desk. He became a multi-billionaire. Steve Jobs, the iPhone is really a computer in everybody's pocket. So the compute went from on a desk into your pocket. Now, it took a long time. You can see Apple videos from 1987 with the Knowledge Navigator, an iPad, which they envisioned more than 20 years before they could actually build it. But they couldn't build it then because the confluence of technology and the cost and the power of processors and all that were not there for 20 years. So it says to me, the next evolution is putting a computer into the network, into the thing. So a computer in every machine, in effect. But right now, the confluence of compute power, cost, small footprint, security is not quite there. Whoever figures this out will be the next multi-billionaire. They'll have done the next Steve Jobs thing. So if you want to do this, go figure this out. Right now, most people think of things as simply little Wi-Fi communication cellular devices that talk to something else. And I think you could probably get away with creating a blockchain system where the movement of the outside blockchain universe is your supercomputer, but you're doing more compute at the local level. But they're not there yet. It's the same thing, by the way, with VR and AR. You look at Oculus, they're going to blow 10 years and billions of dollars in something that was so premature. Somebody's going to come along in about 2022 and finally have a chip, a battery, and a processing system that can actually fit here. That would be a huge, stupid little goggle thing, right? It's just not there yet. 8K vision, you can look at the pieces. One of the things that made Steve Jobs is he would look at the confluence of technology trends and wait. Let me give you some advice in terms of Elon Musk. I can throw him out too because everybody loves Elon. So if you look at these people that really were the greatest entrepreneurs, they actually reverse engineered the future. So it's like, I'm going to go to Everest, and most people go to this base camp and they sort of zig up the mountain. No, start at the top and go backwards to where you have to get at every stage. So Elon wants to go to Mars. Everything he does is Mars. You have no gas on Mars, you need batteries. You need battery cars. You need a boring machine because you got to be underground. You get the idea. He wants that vision, so he's reverse engineering all the pieces to get there. Steve was very similar. He had a vision 20, 25 years later, he could finally realize the technology was ready. So I would challenge all of you to think this way. Look out 15 years, envision what you want to own as your little computer or something, and then try to figure out how to get there, and that's the path you follow, instead of the other way around.
Cool.
Tito's been waiting. Can you wait 1 second?
Yeah, then we'll go slide it, guys.
He's so polite up front, but he's
appreciate it.
Better be a good question, Tito.
Great question. You're gonna love it. It's about VC investing. So your success rate is 70% after you fund a company, and you're talking about lots of pivots and just using the money smartly to find the inflection point. So first, how do you select? What do you consider product market fit? Is it a certain revenue number, or I guess it changes B2B, B2C? And then how do you help them find the inflection point, or what does Bullpen both kind of analyze and provide?
So there's a couple questions there. First, we have a 70% track record of going from post-seed to a big round. But 70% of those companies don't all succeed. An example is one of our companies is FanDuel. You guys know FanDuel? They ran into a buzz store called the New York Attorney General. And they survived. Now they're a regulated duopoly with DraftKings. But boy, they went sideways for 2 years. So, stuff happens. So we're happy with getting to the next round, but there's a journey you got to keep going on before you get out. Product market fit's very interesting because people assert it before they have it. So we've learned a lot of things about product market fit. And for example, Somebody gives us the spend plan after the post-seed round, and if more than half the money's going to engineering, you don't have product market fit. Your own plan condemns you. Got that, right? You should be spending on sales and marketing, not engineering. The second thing we see all the time is they have indications that some people are buying the product, then you call them up. I have a really interesting company right now, but we did a bunch of calls to their core customer base, or people that should be, and they basically told us what's missing in the product before they'll buy it. Don't have product market fit. So in part, the company can convince me they don't have it, and in part, I go out and do research to find out they don't have it. Usually when you have it, certain things begin to happen. You start scaling faster, your growth rate. We love seeing companies that grow 5x year over year, not 2.5 or 3x. You don't always get them, but we love that. Usually you find that your CAC is flat or down, even if you start pumping money out. You get things like this. The months before you get payback on a customer begin to shorten. Everything gets better, and that's a good indication your product market fit.
Can you throw numbers, like a B2B SaaS, like what's the CAC payback you're looking at for a round that you're in?
I love B2B SaaS, but I'm sort of bored with it. I mean, I love the category. We really got to understand it. So let me give you the Bullpen methodology, the simplest way possible. How do I raise 10 on 40 or 15 on 45 in a SaaS company? Okay? Now, it turns out that the public markets go up or down in SaaS multiples. So normally you get 5x ARR to your multiple. It's gone up a little bit recently to 6 or 7. The private markets, because you're growing faster, you should pay 2x that. So if you're 5x in the public, the A round will pay 10x. Okay, I want 10 on 40 to get 40 million pre, I've got to have 4 million ARR. Very simple math, right? Simple math. So then you reverse engineer down to our round. Say we want to get to that A round a year after we invest. You've got to go from where you are to that 4 million ARR and growing into it within a year. That's how we do it. If it turns out that the Series A now went 5 million ARR, it changes our thinking. So it tends to be 80 to 100K MRR growing 4x or more, not 2.5x. You can do the math. And it's just math, right? It's not complicated.
But then what are the underlying strategies? Like, what is Bullpen going to give them? Like, you're a B2B SaaS, you have 80K MRR or whatever, right?
Well, usually you need $3 or $4 million. Your burn rate's probably 150 to 170, you're going to grow to 250. They all tend to look the same in the end. So that's what we do. LTV to CAC, we find LTV illusory. People all know LTV and CAC and all this jargonistic stuff.
It's impossible to figure it out.
Well, no, so we don't look at LTV. It's fake number. We look at months payback because that's real. And you look not at revenue, you look at gross margin.
But are you looking at 12 payback or 18 payback? Or?
Way too long. If you're going to grow fast, you're going to have a shorter payback.
So we'll get one or more
questions. Which is hard. So we say no a lot.
Yeah.
We're cherry picking those contrarian bets, right? That's what Linda wants us to do. So we do have to do it.
Yeah.
So by the way, one other insight for Tito, he likes numbers. Anybody here doing a marketplace? WAG's got marketplaces. Okay. GMV to net revenue. Like WAG's rake is 40%. Pretty awesome, right? Most people's rake is only 20%, sometimes 25. And you got to look at charges and all that and get to the real rake. All right, here's what we figured out. Look at the marketplace. You look at net revenue after the rake. You don't look at gross market value. And it's very similar to SaaS. So the next round might want like a 4 million annualized net revenue to put money in the 10 on 40. So we do the same reverse engineering on net revenue. So if you have a very, very low rake, under 20%, it's really hard to get there. You got to be over 10 million gross market value. If you have a high rake, you can get there faster. Again, it's just math. It's kind of interesting, right? So the weird thing about Bullpen is we look at the metrics, the operating plan, the math first, and then we say, how good's the founder? How good's the market? Blah, blah, blah. Everybody else does it the other way, which is fine, but that's what we do. We just screen a lot out. Don't make the numbers.
So basically, you're a European-style VC in the Valley.
We're probably more like Warren Buffett value investors or something. I don't know.
I'll take more questions from the slide. Thank you, Duncan. Thank you, Tito, for this math exercise. So, bouncing on the ICO thing. So, There are more
We had like a
questions
half an
about-
hour of real venture. Now we're back to tokens. You know, what the hell? What can you do?
So are token airdrops in sound or risky, like sort of, are they good or risky regulatory territories?
Well, it's interesting. I've had an interesting discussion with some very clever lawyers, and they don't all agree. Airdrops are risky, but they may work. So it depends how you do it.
What's an airdrop?
You just give the tokens to your community. You don't actually, excuse me? Yeah, it's like throwing popcorn into the audience. You know. So, but again, the SEC will look at the nature of the airdrop, right? So you argue it's not an offering, but it is something. So, yeah, I think their lawyers are not confident it works. It could work in some circumstance. I do think they have to get the safe harbor for utility tokens figured out. Then you can airdrop. Because you're a utility token, of course you airdrop. You turn on the perpetual money machine idea.
How about the bounty program? What do you think is like, is it in danger or?
Bounty, explain to me what you mean by bounty
So
program. This
maybe
is from
Michael
the field.
can do that. He asked this question on
Faye, do you
slide.
know what a bounty program means?
Yeah, I've been doing bounty programs since my project, so.
Okay, so tell me what a bounty program is.
It's just you do something for the organization, and then you get rewarded with tokens.
Okay, so the question is that a public offering?
Yeah, is it like our ICOs putting themselves into danger by doing a bounty program?
Is there a lawyer in the house, like a doctor? You a lawyer? Yeah. Are bounties okay, or are they public offerings? So he said no. I don't know. The question is this. Once you go down the path of creating a security token, everything you do after that with that token is a security issue. So if you give bounty to an accredited investor, you could do a Reg D, right? You give it to an insider who understands a company. There's an exception for insiders. You give it to somebody off the street,
35.
you only get 35.
Not accredited.
There you go. See? You lawyers, man.
Dancers for money or Dropbox.
I say lawyers are like beavers. They build dams. Stop things.
So one more question, maybe we can take it from the audience, yeah.
I'm just going to speak loudly. I loved how you talked just beforehand about reverse engineering the path. So the one question I'm asking myself is, we hear a lot that technology is exponentially growing, right? And there's this big threat or whatever, there's this threat that eventually technology is going to be smarter than humans. So if I reverse engineer, the question I'm asking myself is, how can we grow human intelligence or consciousness so that technology doesn't outsmart us? And so the question I'm asking is, if we go in 15 years, which trends do you see in terms of how could we build technology, not for the sake of technology, but for the sake of making humans smarter, more aware, or more conscious?
Well, first of all, I reject your premise. Somebody said this once, I'm quoting them. We don't have to mind AI because AI has no mind. I'm not worried about the singularity. You know, we spent all this time to figure out the human genome thinking we'd have great discoveries. No, there's some other layer above it and a layer above that, we don't know anything. So these people that imagine that a future singularity will occur and the Terminator will kill everybody, I think they're in science fiction land. They don't really understand how ML or AI really works. So I'm not worried about that, and I wouldn't put that into your thinking. On the other hand, I listened to Garry Kasparov. Who plays chess here? So you think about poor Gary. He's the first, chess master to get beaten by a computer. In history, it's like, it's the worst. He'll never be anything but that guy. Even the guy that got beat by Go, nobody cares about as much because he's like another game. But Gary, so he spent 20 years processing this as a human being, emotion and panic and how do you explain it? And he came up with a brilliant insight, which is, look at chess. Magnus Carlsen, the world chess champion right now, really incredible guy. What he does to prepare for a chess match is he plays the computer. His rating's about 2,800 ELO rating. The computer's about 3,300. It's much smarter than he is. So he plays against a computer all the time to improve his play. And then he goes to a tournament with human beings. So first of all, the computer didn't eradicate human tournaments. Did not. Secondly, by playing with the computer, the chess today is so much deeper and more precise. And Gary will admit that. So here's the big insight. the future of AI is not us or robot, it's symbiosis. That's right, symbiosis.
So,
the robots are complaining over there. Come on, symbiosis. So I'll give you a very sort of silly example, but one that may be real. So they're putting AI into customer support systems. And so, but the robot won't really want to talk to you because you don't want to talk to a robot. You start swearing at the robot. Sorry to hear that, sir. You want to beat the robot up. So you put a human being who has empathy in between the complaint and the system. And the AI constantly puts up information for the human to make that person get the right answer. But the human has to show the empathy and calm them down and get them to be a good customer. It's kind of like jacking into the matrix, right? I want to fly a helicopter, jack in, I can fly a helicopter. I think that's where we're going. It's not that we'll jack in, but these AI systems will go in symbiosis with people and we'll all be a lot smarter. There's some really good thinking on this. So, Tito, you got a comment?
Have you yet invested in an AI company that enables customer support agents?
I've looked twice at it, and it just didn't fit the Bullpen model, but I liked them both. So there are companies out there doing this.
Yeah.
So, yeah. It's a cool thing. Okay, was that the last question?
Yeah, it was the last. Can we take?
All right, one more.
One more, the last one. It better be a good one.
Jeez.
Let me see that boss. When you guys invest in a company, how active are you, if at all? And if so, how do you add value to your portfolio of companies?
Okay, is that Sydney or Melbourne?
Auckland.
Okay. I'm trying to give a funny or clever answer, and I can't really think of one, so I'm at a loss. You stumped me to have something funny. So, what's your company? You're just starting out? Okay. I'm actually stumped. I have no good answer for you. The accent put me off. All right. Are you guys entertained?
Yes.
I feel like the guy in Gladiator. Are we not entertained? He was Australian, wasn't he? So, no? Russell Crowe? I know, you're a Kiwi. He's a Kiwi?
New Zealand, yeah.
He's a Kiwi. I'm sort of gobsmacked again. So, just one last personal note. I spent a year in Christchurch. Fendleton Open Air School, I was a little kid. Played rugby, cricket. I had no idea what I was doing. I tried to bowl, like chucking it like an American pitcher, and they started yelling at me. So, anyway.
Thank you, Duncan.
Thank you.